Hello value investors, thank you for joining me. Today I want to talk about DocuSign and why I believe the DocuSign is a compelling investment despite appearing to trade at a premium valuation. So a few things that are worth pointing out that we're going to go through are its growth rates, looking out to its guidance for fiscal 21, which coincides with calendar 2020. We're going to talk about the rule of 40. We're going to talk about the blemish in its results, which are billings, and I'm going to talk about its valuation. So if you're new to the channel, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why, with balanced arguments for the stocks I own. So let's get started. What is quite attractive about DocuSign is that it's still pointing to revenue growth rates of 40%. So it's very steadily in the high 30 to low 40 range. You can see that going back several quarters and looking out ahead. So this is very attractive because in a period where many companies, including SaaS businesses, are now growing at sub 30% growth rates, DocuSign is still pressing on ahead, and this is very attractive. Moving on. From a rule of 40, I suspect that if you're watching this video, you already know, you're very familiar with the rule of 40, but if you're not, the rule of 40, in a brief recap, is if you get a 40% number or higher, it's very attractive. The way to measure this is looking out and comparing what its revenue growth rates, and we're looking at operating profits. I've used non-GAAP operating profits. This is kind of industry standard. So in the quarter just now, they had 10% operating profits positive, and the growth rate was 45. So those two added together come up to 55, which is higher than 40%. So that is quite attractive. So it means that DocuSign is balancing revenue growth rates with profitability. You may contend that the business's costs is basically the stock. So essentially the management gets paid in stock-based compensation. So if you're adding back its costs, then obviously it's like saying a business without cost is very attractive. Yeah, of course, a business without cost is attractive. So you have to temper that 55% number with some excitement. But all in all, compared to other SaaS businesses, it's doing quite well with the rule of 40. One thing that I didn't particularly think is very strong was that the billings came out is not so strong. So right now for Q2, billings came up as 61% year over year as an increase, and in Q1 they were 59% year over year. But looking out to the end of the year, it's according to its guidance is coming around 48%. You can see this reported here. So they say that for Q3, if you look at its guidance, is coming around 42% year-over-year growth rate. So it's going from 61% in Q2 after growing 59%, then into Q3 it goes to 42%. This implies that looking out to Q4, it should be coming around 30%. So billings is a very strong forward indicator for SaaS companies. So for something in Q4 is really going to be marked by a rapid deceleration from the period we've seen in H1 21, which coincides with the first half of 2020 calendar. So the company, this is something that I'm kind of looking at around, and it's something to bear in mind that if billings continue to decelerate quite rapidly, it's just a matter of time before revenue growth rate decelerates. So I don't think it's particularly the most damaging thing right now, but it's worth considering. Another aspect that's kind of in the investor's mind is that it's trading for approximately 22 times next year's sales. This is not cheap. And I'm a value investor, so for me it's very important valuation. Valuation is a significant driver of upside returns, and it already is trading at a very punchy premium. In my mind, if I compare it with other crowd favorites such as Okta or Datadog, it trades cheaper than those two, and in the case of Datadog, it trades significantly cheaper. And in the case of Okta, it has higher margins, gross margins, even on the GAAP side than Okta. So it trades cheaper than these two, meaningfully cheaper than Datadog. So it's a report. So in summary, there's a lot to like here in DocuSign. It's growing very strong and steady, but we have to bear in mind that this is because all SaaS companies right now trade at a very large premium. Whether the tech sell-off from last week will continue or not, I don't know. I don't think it will, because I think that if you look elsewhere where investors are likely to go to, there's not a lot of businesses right now that are growing so strongly as they are in tech. So yes, tech does trade a large premium, but the market is not entirely unjustified in thinking like that, because tech is growing fast and many other companies are either struggling for growth or are having to pull their guidance. So I think that this is a possible opportunity that's worth considering. In the interest of disclosure, I am long DocuSign, so you should bear that in mind as you watch this video. And as always, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns, and I'll tell you the stocks I own and why. Thank you for watching. Bye.